welcome to the first episode of Meet the Investor for 2025. Joining us today, we have Ben Leung, Head of Systematic Investing at Macquarie Asset Management. Hello, Ben. Thank you for joining us today.
Well, thank you very much for having me.
If we could just start with you telling us a little bit about your career journey, your role at Macquarie and the team you work on there.
I've actually been at Macquarie for 24 years now. My background is in software engineering, and near the end of my education, I'd really discovered a passion for using technology to enhance decision making. And in the last 20 years, I've had the privilege to point that passion specifically at investment decision making, how to use technology and data to invest the outcome. And over the course of the last 20 years, I've been a quant researcher to try and figure out how it all works. I've been a portfolio manager to road test those ideas, and over time grew as our business became more credible into head of research, into co-head, and today now head of the systematic investment team. Today we and my team of 13 investment professionals use our expertise to service $72 billion of assets under management, helping clients from all walks of life, from sovereign funds to superannuation to mum and dads, to understand the markets, to implement their financial objectives and ESG requirements. So, I'm deeply passionate about this field, particularly around the development of AI, but also the fact that the public is really embracing data-driven decision making. So I'm very pleased to have the pleasure to speak with you today.
Thank you, Ben. So your team gets involved in buying and selling stocks in the share market, but you operate in a very different way to traditional fundamental investors who might look manually at the data in front of them, meet management teams, assess the quality of the companies, and so on and so forth. How accurate is that statement, and what is it specifically that you guys do to decide whether a company is a good investment?
I mean, there's a lot to unpack there. There's definitely a level of accuracy, and what we do can appear foreign to investors who are familiar or trained in a fundamental way. But what we do is not new. Our team has 25 years of history in applying systematic techniques to the equity markets, and our peers have decades more than that. So there is a strong tradition here. And at the very core, the fundamental concepts used by fundamental investors are the same. All we're looking to do is really put to use the increasing knowledge of markets, microstructure, investor behaviour, the benefits of technology, the richness of data, and really have a process of continuous evolution such that we can meet and deliver the financial outcome in an increasingly complex world. And if you look under the hood, it's actually a very clear series of steps, clear logical steps that we go through. It's not a black box by any means. And whilst we don't do, qualitative analysis to assess a company's growth or business strategy, we look at concrete metrics like return on equity, on accruals, to look at how it performs against its peers. We can take those metrics and in a consistent way evaluate how it stands amongst its peers, both locally and globally. And while we don't meet company management, we might be influenced by a charismatic CEO, we do undertake machine learning on transcripts, on broker reports, on news snippets to really understand the sentiments of the market around that stock. And over the course of the 30 years that we've been operating, we have iteratively researched thousands of these types of signals to identify ones that allows us to form a view on a company. And today we've got 70, a little bit more than 70 signals. And your point about a great company versus great investment is quite important, because the neat thing about quant is that you can then take each one of these metrics and see a statistical relationship with future returns. And as the world evolves and as new data comes through, we apply those 70 signals to evaluate what a good investment opportunity is.
So as part of your answer there, you mentioned looking at investor behaviour. and potentially that can feed through into some signals as well. Can you give us examples of what sort of investor behavior generates signals in a way, or opportunities?
Yeah. I mean, at the end of the day, regardless of whether you're fundamental or systematic, I think we can all agree that the biggest challenge for successful investing is actually investor behavior itself. And these behaviors are not negative or positive. They're obviously built in the human psyche through our evolution, and in fact, lead to our success as a species. But they do challenge our effectiveness as investors in the markets. And if I name quite a few of these behavioral biases, you would see them in your own behavior and see them in the public. The tendency for individuals to copy the actions of others, which makes a lot of sense in the natural environment. Safety in numbers, safety in herds, creates momentum opportunities or trending behaviors in the market. The risk aversion nature of human psychology is very real. Getting hurt in the real world does increase the odds of death or injury. And it makes sense that we feel pain or loss twice as intensely as a gain. And that creates opportunities from a valuation perspective. When a beaten down stock goes down 90%, nobody would touch it regardless of how strong its fundamentals are. And the systematic process is designed around the appreciation that the market ultimately is interaction between fundamentals and investor behaviors. And having a structured process allows us to protect our clients from our own biases while being able to see clearly how the behaviors and the biases are playing out in the market.
So would you say you potentially take advantage of natural greed that investors have in their behaviors and fear on the other side as well, and avoid that yourself?
Yeah, I mean, fear and greed is definitely key drivers there. Things like buying into stories and narrative is another feature we often see in the markets. And there's a lot of great literature demonstrating how prevalent some of these behaviors are. And in our opinion, to fully capture the opportunity in the market, you need to be both aware of the fundamentals and the response that the investors are having in relation to those data points.
So you touched on literature there. A lot of these signals that you have developed and your team has developed, do they come from academic research? Do they come from internal research? Is it trial and error? How do you come up with the signals?
I mean, inspiration can come from anywhere, and we have no limits on sourcing ideas just from ourselves or outside or for academia. What is most important in the process really is the diversity of thought. So if you look at our staff, they extend well beyond your traditional financial professionals. We've got physicists, we've got computer scientists, we've got engineers, all really focused on applying, I guess, a scientific approach to investing. But where it stands is ultimately, regardless of where the ideas come from, we do a lot of in-depth R&D internally to ensure that our hypothesis and the data and the proof points are satisfied before we implement. In terms of the things that we look at, the investment process is a well-oiled, machine. We break it down into 5 main steps, starting with data. The next step is changing that data into information. Then we think about how we turn that information into a strategy. Then we think about how that strategy converts into a fund, and then following that attribution and to create that feedback loop. And the team's constantly thinking about how to innovate iteratively each one of those portions to make sure we're maintaining our edge and also being responsive to how the market's playing out.
So maintaining edge is a key point there. Traditionally with quantitative strategies, or not traditionally, but a traditional criticism might be that as people figure out these opportunities, that they can be arbitraged away. In other words, many people start following their strategies and the opportunity to make money isn't there anymore. How does your team monitor that and mitigate against that risk?
That's definitely true. And that's not unlike, I guess, a stock story playing out or stock thesis playing out. Certainly some of our strategies and signals do lose efficacy over time. Signals that typically fall prey to that, I guess, outcome are informational asymmetry type signals. So signals that work because you are either getting information faster or you're getting information that others are not getting often fall prey to arbitrage forces as that data becomes democratized. If you think about simple strategies or maybe even basic quant strategies, you do see them being arbitraged away, but because of the fear and greed you spoke about, they actually become quite seasonal. So when the strategy is no longer returning, then investors flee, and then the strategy starts working again. And the core of our signals are actually based on human behavior. And as we spoke about earlier, they're quite innate to us as creatures, and how they manifest does change over time. So there needs to be constant R&D, but the core of our signals does rely on very strong, case and persistence, which is some of the things that we look for.
And you talk about people changing the view when signals don't work, or investor behavior. As a follow-up to that, we do appear to be in a very fast-changing environment, whether that's geopolitical, structurally high interest rates and inflation, and in particular technological advancements such as AI, and how that may affect business models, but also the development of AI itself, as we've seen recently in the news. How does a systematic approach allow for changes like that, things that are going to be different going forward when a lot of your analysis might be historical?
Yeah, I think that's definitely something that we've been thinking a lot about. But in my opinion, a quantitative approach is actually well suited for a dynamic environment. If you think about the process itself, it is always responding to new information and adjusting to new environments. And, evolution, agility, adaptability is built into that process. And for us, as I mentioned before, we're always tweaking how our process is working. In relation to changing market environments, we are always looking at new sources of data. We're always looking at new specific signals. And more importantly, I guess more recently, is looking at how those information actually turn into insight. I think information as an edge, particularly in this day and age, has reduced in its significance, but deriving meaning is where the edge can be now. And we're constantly tweaking our process in response to the oncoming challenges. But ultimately, what is important is the fact that we are testing our own philosophy. We're challenging ourselves, we're challenging our own worldview. And, AI has actually been a great enabler of that. We are able to run a lot more scenario analysis, and built into our process actually is the ability to generate what we call a multiverse. So we challenge our models and our expectations with what not only has happened in our singular existence, but also what could have happened based on what we know about the past, to ensure that the signals are actually robust and, risk managed in relation to some of the challenges that might face going forward.
The things you've covered there and in previous answers, sounds like there'd be a lot of resource required, systems, data. How much of that does your team use?
Yeah, and we're very grateful to be part of Macquarie, because then we can lean on an enormous set of resource for the latest in cloud infrastructure, in AI enablement, in software, as well as development. But to give you a sense of scale, every week we collect over 100 million new data points, covering 2,500 stocks. Each stock has 700 to 100 data points, 700 to 1,000 data points, sourced from over 40 vendors, covering information that would be very familiar with a fundamental analyst, but also things that might not be, in terms of the behavior of securities or related securities in adjacent markets like the options market, the shorting market behavior, ESG information, non-structured data like transcripts, news, which we spoke about, to really give us a diverse view and a complete picture of the opportunity set that's available.
So drilling down through your 100 million data points and you said covering 300, 250 securities, you find a security at the end of all this process, a company that you like to buy. How confident are you in the chance of it outperforming, and how do you manage the risks if the signals are wrong?
Yeah, I mean, we're pretty confident, but we also acknowledge that our confidence doesn't necessarily mean that it's going to happen. So the secret sauce, and I think whether it's fundamental or quant agrees with this, is diversification. And diversification for us means that every position we take or every opportunity we see, we want to do it in such a way that it's not concentrated in a name, single stock. It's not concentrated in a particular sector, particular country. It's not relying on a particular macro trend or thematic like AI. And our systematic process utilize a number of what we call risk models to ensure that we are managing against the potential randomness that could derail the investment idea in the case we have in the first place. And for every effort that we actually spend trying to source and improve our stock selection, we spend equally, if not greater, effort to ensure that the risk is managed in a very sensible way.
And can you give an example of where the signals have been particularly effective, possibly particularly in the face of maybe where the fundamental analysis might disagree?
Yeah, I mean, I won't tie it into a specific fund or position we have, but I think if we look back in 2024, one of the standouts in the Australian market was the dominance of the momentum factor. And for those not familiar with the concept, momentum is the observation that stocks that tend to go up continue to go up, and stocks that go down continue to go down, regardless of, with little regard for valuation or any other sense of fundamental. And momentum's always been a feature in the Australian markets, but in 2024 it was particularly dominant. And the case in point there is the rise of the Commonwealth Bank, CBA, a significant stock in the stock market, got much, much bigger still. It posted 40% gain. One of its best years in a decade, was used to trading at 16 to 18 times PE, now trading at 26. And in that particular scenario, that has held true. So it went up and it continued to go up, and it's really confounding a number of fundamental approaches. And if you were to simply implement momentum in Australia last year, depending on how you calibrate it, you would be reaping an excess of 10% return above the market potentially.
So looking forward then, with situations like you just described and the fast-moving environment that your team sounds very well equipped to handle, what would an ideal balance be potentially between traditional fundamental investment approaches, maybe some passive investing, which has been a huge trend for many years now, and more quantitative or systematic investing like what your team does?
Yeah, look, I think the right answer is always going to be depends on the investor. If we, look at the strengths of each one of those investments, passive is obviously a very cost-effective way to get access to the equity premium, but you don't have a great deal of control around the returns or the volatility that the market will bring.
Because you're just buying the whole market at that point.
Yeah, you're buying the whole market. Index selection becomes quite important there, whether you buy the 200, 300 smalls or micros. But once you make that decision, you kind of let it loose, right? With active management, like fundamental or quantitative, you've got a little bit more control around the return that you want to target, perhaps the volatility. And for some investors, ESG considerations or value preferences. So those are quite important things. Quant, obviously close to my heart, and I think it's very effective as a long-term, cost-effective way to access excess return. But I do appreciate that fundamental investments or investment approach do have an edge, particularly in segments where it's information poor, in segments where there's a lot of regulatory change, or segments where it's just emerging and there's no historical data. So ultimately, if I was to fall back into why I got into quant in the first place, I would let the data drive that decision. And the optimal mix is probably, an allocation to all of them, depending on what the goal is.
Great. Thank you, Ben. That was incredibly insightful overall. Thank you for joining us today.
Welcome, and thank you for having me.